Welcome, everyone. Thank you so much for joining us today. All right. Well, welcome, everyone. Today's topic is talking about strategic generosity, and we're going to discuss being a better giver today and look at different ways that you can utilize giving strategies and really put a sense of purpose behind giving in general. My goal here is not to tell you to become a bigger giver, but if you're charitably inclined and you're wanting to know ways of making sure you're giving in a tax efficient way, we're going to discuss a few of those ways today. Just to give you a little bit of background about myself, my name is Aaron Rheaume. I'm the Director of Financial Planning at FEG, or Financial Enhancement Group. Certified Kingdom Advisor. I have a very strong passion towards helping people steward resources well. And just being transparent, I do that with Christian values. I know that not everybody watching today may not have the same type of values that I have, but that is my faith, and we'll talk through some lens of giving through Christian principles and just in general in giving. If you're not a Christian, what I will talk about still is very impactful if you have other things that you're wanting to accomplish from a giving strategy. Just as a disclaimer, the Financial Enhancement Group is an SEC registered investment advisor. That means that we manage more than $100 million in assets, and so we are registered with the Securities and Exchange Commission. FEG is a 28-year-old company. We have 4 offices here in central Indiana, and we serve a little over 1,200 families in 31 states. As Tarna mentioned in our opening, we do have upcoming workshops. We're going to skip June. In July, we're going to talk about legacy planning. So we're going to talk about strategies for future generations. What we're going to discuss today will lay the foundation of what we're going to talk about in our legacy planning series coming up on July 24th. In addition to what I'm going to talk about, we're going to have a couple polling questions. Today, I want this to be as interactive as possible. I'll probably talk for maybe 30 to 40 minutes, wrap up at the end. If you have questions, please throw those in the chat format of the Zoom webinar. I will get to those at the end. So if you have questions, if you hear something that sparked an idea, sparked a question, please put those in the chat box and I will answer those at the end. So you can see on the screen, upcoming webinar is going to talk about legacy planning. So let's dive in. First question that I have is, how satisfied are you with your current giving strategy? How many of you have a giving strategy? You should see a poll up on the screen. So 1 says you are 0 is you're not currently giving, and 10 is very satisfied. So wait to see some of those answers come in, and Tarna, if you can provide me feedback as when you see that, I'm very curious.
All right, Jubilee, we'll go ahead and share the results. Perfect. You guys should be seeing the results on your screen. Aaron, are you seeing them?
I am. Thank you. So we
Hold
do
up
have a, go
slew of
ahead.
people coming in if you want to welcome them as well.
Yes, welcome everybody that's coming in. My name's Aaron Rheaume, Director of Financial Planning. Today we are talking about strategic generosity, and we do have a polling question. And the first polling question is, how satisfied are you with your current giving strategy? And 0 means not giving at all or unsatisfied, all the way down to 9 and you're highly satisfied. So we do have a diverse response there. So hopefully what I talk about today will give you some ideas to think about with giving overall. All right, moving along. Get this back on the right screen here. So a couple things we're going to cover today. A few of them are going to be a little bit more abbreviated, and then I will go into detail into some deeper topics. So we're going to understand what generosity is, strategic generosity. We're going to talk about giving with intention. We'll get into some smart giving strategies, looking at how to amplify your impact all the way down to what are some practical steps you can take to be generous. And so, really, when you dive into strategic generosity, um, there's that can be defined differently for um, everyone. It's really based on your values. It's based on your beliefs. Um, but when I say that, there is an intention behind that. So being strategically generous is making sure that you are intentional with things that you like to support, with those beliefs, with those values, and making sure that it's aligned with your faith and values. And there's a difference between giving and strategic generosity. The difference between giving is just doing it out of habit with no intention. Maybe there's a need arise and you're able to donate to that. That's all good, but where you can make a bigger impact is using a plan. And we'll talk about that a little bit more in detail on how to be strategically generous and wise with your giving strategies. Thoughtful generosity, it can enrich your life. It enriches your legacy. Through generosity, a lot of areas of lives can be impacted, whether it's donating to a church, donating to, cancer research, donating to any sort of charity that you're passionate about. So most people that we help here at the Financial Enhancement Group, when we walk them through their strategic generosity, I can see their faces light up when we talk about the charities that they want to support. I can see their face light up when they talk about being able to help with a mission that they're passionate about. When there's a church building that needs to be built and they have the resources to be able to do that, I can see that. And as a financial advisor, it warms my heart because I'm not in the business of helping people hoard money. Stewardship is about making an impact, and we really teach and coach our families how to do that well at the Financial Enhancement Group. So giving with intention. As I mentioned, you want to make sure you're giving with your core values and beliefs, and those are different for everybody. As I said, I'm a Christian, so my core values are probably different than a non-Christian, and I'm openly fine with that. Um, Having a vision allows you to move in a deep manner, as I talked about. When you have a clear vision, you can be clearly articulate in how you're going to make an impact in several families' lives. Um, Personally, my family loves to help support missions, and so we sponsor children through World Vision. We're able to write letters back and forth to the kids that we have sponsored. We get updates on how we're enriching their lives. Um, what's very, I would say, from a monetary standpoint, it doesn't cost us a lot, but it surely makes a big impact in that child's life in another country. It allows them to put food on the table, have proper clothing. And so you can make a deep impact when you have a vision on what you're trying to accomplish. And it shows from a family aspect that we want to make an impact. It teaches my three daughters about the ability to have an impact on others' lives. And so giving with intention in just not doing it out of just habit, it can be very, very impactful. A couple things that we'll move into is donating in general. Most people that we talk to prior to getting to the Financial Enhancement Group have one form of giving, and that is generally through cash or checks. We're going to debunk that myth. It's not really a myth. Keep giving. We're just going to look at a better strategy or a couple better strategies to be able to give. So in general, how do you all tend to donate? We're going to put up another polling question. There's several items on there. Do you gift directly through cash, online giving? A few of these we're going to talk about in detail. And so give you a few seconds to fill that out, and we'll look at the answers as they come through. All right. Okay. My assumption was correct. Most people give through cash, checks, online giving, tithing, regular church donations. All of those are a good way to give, and I'm very happy for that, but it may not be the most efficient way to give. And so we'll talk about a couple strategies on being more efficient. So thank you to all of you that are giving and do so on a monthly basis or weekly. A lot of you said you tithe, and so I know there is good giving going. So donating. All right, move on to the next slide here. Three areas of focus that I want to talk about today are donor advised funds, qualified charitable distributions, and gifting appreciated assets. Those are all very different and very strategic types of ways to give. The first part is a donor advised fund. The reason why at FEG we look at ways to use other gifting strategies is because of the tax benefits that you can get doing the different type of gifting. If you are writing checks or doing online donations, that is the simplest form to give, and that is a good way to do it. You can still get a tax deduction. Now, in the United States today, it's very difficult to get a tax deduction because our standard deduction has increased so much with the Tax Cuts and Jobs Act that took place in 2017. Currently, we're in the last year of the tax code sunsetting. And so right now, Congress and our administration and the House and the Senate and all those folks are walking through what our tax guidelines are going to look like for 2026. So at the end of this year, if no changes are made, our marginal tax brackets are going to increase. The lowest tax bracket that we have in the United States is 10%. That's going to stay the same. Where you would see some increases is in the tax brackets above. So our 12% bracket's going to go to 15, the 22% bracket's going to go to 25, and then the top tax bracket is 37%. That will go up to 39.6% with the caveat that there are no changes made by the end of this year. It is highly likely there will be some different form of tax code by the end of the year. We just don't know that. So I say all that is getting back to the cash and the check. If you cannot, as a married filing jointly individual, take a itemization of more than $30,000 a year, your cash and check is not getting deducted on your tax return because you're just taking the standard deduction. So what a donor advised fund does is it allows you to create a giving fund for a long period of time. Where we see this probably the most utilized is in a large cash donation, or we see a business sale and someone is recognizing a lot of income coming in from a business. A donor advised fund allows you to offset some of the taxation. If you were to move money into a donor advised fund, you can get up to a 60% deduction of your adjusted gross income for a cash donation to a donor advised fund. How that would work is, let's say you sell a business for $1 million, and we're going to look at where the income is going to come from. Some of that's probably going to come from capital gains, which is taxed differently, and some of that may come as ordinary income. But we know we have $1 million that's going to hit the tax return this year. Well, one way to offset some of the IRS sharing in that business sale is to take a large portion. And this is a strategy that you would want to talk through with your advisor on how much you could add to a donor advised fund to offset some of those taxes. So if you were to give $100,000 out of that million, that would make a deduction on your tax return up to $100,000. So everybody following with me? It's very complicated, but that donor advised fund allows you to make a deduction of $100,000. The donor advised fund also allows you to invest money. So in a donor advised fund, you can have an investment account. Those assets can grow over a long period of time, and then you can make distributions out of the donor advised fund directly to the charity, but you're getting one large tax deduction in the year of that business sale. So that's where a donor advised comes in. If you're wanting to do a larger donation, if you have the resources to do a large donation, a donor advised fund would be something to consider as stretching out your giving and offsetting taxes in one year. Where we probably do the most is through qualified charitable donations or distributions. And those are donations that come directly out of tax deferred IRA assets. And there's a couple rules that you have to follow when doing qualified charitable distributions. The first rule is you have to have an IRA. So you have to have an IRA, and it's not a Roth IRA. So if you have an IRA, you will eventually qualify to be able to do a charitable distribution. The second rule, you have to be at least 70 and a half. Not a day sooner, not a month sooner, not a year sooner. You have to be 70 and a half. So the day that you turn 70 and a half, you can do a qualified charitable distribution. The benefit of that is it can reduce your future required minimum distribution. So there's a lot of acronyms that I'm throwing out. You've got a QCD, and then there's a big term called an RMD. The RMD is what everybody's going to be subject to if you have an IRA and you reach age 73. The IRS is going to force you to start taking money out of your IRA accounts. That will change in 2033. We've got 8 years, but in 2033, your RMD will push to age 75. The benefit of using a qualified charitable distribution versus giving out of cash is not because you're going to get a tax deduction, but what it does is it's not recognized as income on your tax return. And as a single person or a married person, you can give up to $108,000 in one year as a qualified charitable distribution. So we've helped families here that might have gone through a church build or maybe a big mission project where they have a large IRA balance, and we're looking at strategies to give. As long as they're 70 and a half or older, we're able to take that, donate it directly to the charity. The charity doesn't pay tax, and it's not recognized as income on your tax return. So that's a beautiful way to make an impact on a charity, but also reduce your tax liability. I've been doing this for over 20 years with the same company for the last 11. The one thing that I can tell you without a certainty is most people that have saved well, that have built up assets over time, that have an income from other Social Security, pension, any sort of rental income, you name it, most people are not retiring in a lower tax bracket. That has been a complete myth. And I can show proven data time over time again that the families that we serve, they are not in lower tax brackets. And so using these strategies help offset some of that tax liability that's going to come in the future. So if you have questions on qualified charitable donations or donor advised funds, please reach out to a professional to make sure that they're working with you in your own individual or strategy. Don't try to do this stuff on your own because there's a lot of rules and regulations that you have to follow, and each situation's unique. The last way to at least look at giving is looking through an appreciated asset donation. A lot of times we find because of the families we serve, they've worked for, maybe one specific company for a period of time. Here in Indiana, Eli Lilly's a big employer. I used them as an example in our last webinar. A lot of the Lilly employees have some form of stock units or stock awards as part of their compensation package. There's been, Eli Lilly stock given and gifted to families over generations, and so that stock has significantly increased in value over the last decade and really recently in the last couple of years. So what gifting an appreciated asset is looking at an asset that's gone up in value. So, and I'm going to use Lilly as the example. Let's say you purchase Lilly stock at $10 a share, and now it's worth 100. It's much greater than that at the time of this recording, but for simple math purposes, you bought it for 10, it's worth 100. There is a $90 difference. If you were to help fund, let's say, that church giving campaign, and you go and look, oh my gosh, I've got some Lilly stock here that I can go and recognize as an asset. Why don't I sell that and then use that to go towards the building campaign? That would be a bad idea because you are recognizing the taxation on it. What we want to do is push the tax burden to the nonprofit. And so as long as you're donating to a not-for-profit, nonprofit, a 501c3, they're registered, and they can accept stock donations or appreciated asset donations, we can shift that tax liability directly to the nonprofit. So in that same example, if you were to move one share of Eli Lilly stock to the charity, that charity, as long as they're a nonprofit and can accept the stock donation, would be able to sell it and they don't recognize the tax. What you can do is deduct it on your tax return as long as you itemize. So there's also another difference when you're looking at the taxes. In gifting appreciated assets, you can only deduct up to 30% of your adjusted gross income. So if you make $100,000 a year and you wanted to give $30,000, you could deduct $30,000 on that gift. Now, married, filing jointly, that is your standard deduction. So we would want to make sure and look at if there's mortgage interest, your state and local taxes, all of those things would stack up to allow you to itemize. So gifting appreciated assets is another very good way to be able to give and do it in a tax efficient manner. Just because there's a lot of appreciated assets. A lot of you on this screen have saved well, you've accumulated well, and there's just different ways to give than the majority vote of giving out of cash or a check. I don't want to say don't give, but if there's strategic ways to give, it makes more sense to give out of the three things that I've listed so far. I'm going to pause any questions that you all have on the three types of gifting strategies? If you have a question, just throw it in the chat, and I will go back and answer it at the end. And then we're going to recap here in the next 5 to 10 minutes. So amplifying your impact is using tax efficient strategies to be able to increase your giving capacity. And that is exactly going back to what I was just talking about. The other big thing that I see with folks that come to FEG as they're moving into the last phase of finance, and that's distribution, is a lot of people give out of income because that's what you're taught to do, especially if you tithe. You know, you give the first 10%. And so during a working career, you know, let's say your annual income's $150,000 and you're giving that 10%, that's $15,000 a year. Well, if you have a reduction in income because you're not working, but you still have Social Security and pension, maybe your income has gone down to $100,000. And so now you're giving 10% of the 100,000 and your giving just decreased by 5,000. And so that really can hurt a charity. And so if you're looking at other tax efficient strategies and you're in that distribution phase of life, you have to take a different approach to how you give because it doesn't come out of income anymore. You want to make sure your gifting strategy starts to come from assets and not income. And so that's where using the qualified charitable distribution, the donor advised fund, the appreciated assets, that can still have a major impact on those charities. Um, we'll go through, you know, just what it looks like to multiply your generosity without additional financial strain. We show that to families here in the office on how to continue to give, how to continue to steward well. And the reason we do that is because most people have a preconceived, no, not preconceived, they have a fear. And the fear is that they're going to outlive their money. I see Jamie on the screen. Jamie's one of our financial advisors in our Lafayette office. She could probably also identify most people have a fear of outliving their money. And so that fear allows them to maybe have a muddied mindset on their giving because they are fearful they're going to run out of money, and so they're less generous than being able to show people how it works through a financial plan, be able to show people that keeping up with your giving you know, will not allow you to run out of money and give you the confidence to continue to be generous. And then it gives us the ability to reinforce your personal and family values. I highly encourage folks to at least have some form of family gifting strategy. We'll talk through a little bit more of that in our next series on legacy planning. But it's really setting up the next generation of being generous. And so that is again where I'm passionate about is we've been called to steward these resources, especially from a Christian perspective, and we've been called to steward them very well because honestly, everything we have is all owned by God. And so it's our job to make sure that we're taking care of that well and not hoarding wealth. Um, Wealth is not a bad thing. The heart behind that is where you can get into some trouble. And so creating a legacy of generosity is structuring how you want that to look like with your family. And you can have a lasting impact on that. And it's not just from a monetary standpoint. It can be from a value standpoint. It can be from a faith standpoint. Involving the future generations in your vision. Jamie and I both have young kids. And instilling those values in them at a young age, I see it already paying dividends in my 16-year-old. She's more generous at 16 than what I ever was at 16. I don't even know what generosity was at 16, but just being able to instill some of the values that my wife and I have allows us to see the impact she's making on her own generation. Um, and then again, we've talked about this already. It allows us to have a legacy um, from a family standpoint. I want to make sure my legacy is uh, where my family is set up to be able to maintain my gifting strategy. I want to make sure that my legacy is honored with making sure they're stewarding resources well, and having those conversations are tough, but they're also necessary. And making sure that when you get into, and I said this earlier, when you get into that legacy planning portion of life, these are where these conversations become more and more prevalent. Um, I don't think we have a poll for this. If we do, I'm not going to go over it anyways. Just, think of times when there might be a biblical principle or there's a story that comes to mind where there is generosity, and generosity comes from all facets. It's not just monetary. It can be from giving time. It can be from giving, maybe from an educational standpoint, you're helping someone. There's so many things that you can be generous with. Most people think it's monetary, but it's so much more than that. One of the stories that comes to mind from a biblical perspective for me is Mark 12:41 through 44. And that is where Jesus tells the story about the widower's offering. And so this gets to the heart of how you give. In those three verses, it talks about how the wealthy gave, and they only gave a small amount of their overall wealth, but the widower gave everything she had. And so that comes from a heart perspective. When we look at stewardship, it's almost a upside down approach. You're looking at it from a kingdom, or at least I look at it from a kingdom perspective. So what do I do here on earth? How is that going to have a lasting impact on God's kingdom? And that's what that story tells, is what it resonates is she gave all she had. She gave from the heart. And so that's what stewardship means to me. Um, why do we give? Is that a polling question? Sorry. You can shake your head no. All right, thank you. There's some biblical principles behind it. Stewardship in it really, again, is just aligning spiritual values for a deeper fulfillment. And it can be a demonstration of faith. So just to wrap up, some practical steps to make sure you're being generous, and being generous strategically is evaluate what you're currently doing. So, some of you said you give out of cash donations. That's a wonderful thing to do. But giving out of an appreciated asset or a QCD or a donor advised fund may make more sense in your financial situation. I don't particularly know it, but it may make more sense to give out of one of those. Aligning generosity with your financial and spiritual goals. We've talked about that. The next step is evaluate, then align, and then move into periods of check-ins. And so things change, values change. Um, Beliefs tend to stay the same, but some values change. And so if values change, are you still giving to things that you're passionate about, or are you just kind of on that autopilot of giving versus being very strategically generous? We're going to wrap up. I want to know if there's any questions. I covered a lot of information in a short amount of time. The bulk of the information was definitely pushed at three areas. It's the donor advised fund, your qualified charitable donations, and then the appreciated assets. But most importantly is making sure that you have a purpose and an alignment with how you give and what you give to. So if you have questions, please pop those in the chat feature. I
Hey,
can answer those.
one of our guests today was not able to come off mute, but when you had asked earlier if they had any questions, they sent me this one right at the end there. It says, are donor advised funds better than setting up a private foundation for legacy planning?
Um, that is a great question. Without knowing the very specific details, it's hard to answer that. I can tell you from experience, a private foundation is for a much higher net worth, versus where a donor advised fund would be, you've got a business sale and you're trying to offset some taxes in a specific year. A private foundation would be making sure that you're setting up a lot more assets into it and being able to distribute those over a longer period of time. So that's a great question. I would have to know more about the specific situation. Jamie, I'm going to put you on the spot. Anything you want to add to that?
No, I agree. I would say the donor advised fund is more specific for in one year you have a large income that you're trying to offset. So you make a donation that one time and then can gift over the years. A foundation is more long term and for wanting that to carry on past just a few years of gifting, like a donor advised fund.
Yeah. And so that was, again, really good question. Yes, it may make sense, but without knowing the specifics of that financial situation, I can't give a definite answer. Any other questions?
Aaron, I saw two more come through. I don't know that you answered. Um,
Okay.
One was from Shelly. She said, maybe I missed this detail. In donating appreciated assets, how much can we claim as a deduction? The amount we paid for the stock or the appreciated value?
Great question, Shelley. It is the appreciated value. So the amount you paid for the stock is called basis. The difference is between that purchase price, the basis, and what you sell it for is called the capital gain. But you would get the actual value of the day of the gift. So go back to that Lily example, where you purchased the stock for $10, it's worth 100. If you were to give that one share, you would get $100 write-off. But keep in mind, you have to be able to itemize in that to be able to get a tax benefit. Um, so you still get a tax benefit per se because you can transfer that capital gain to the charity and you're still able to give. But in order to it to have a big impact on your taxes, you have to be able to itemize it versus taking a standard deduction.
Then there was one more question from Jeffrey. How about short term appreciated assets? How would that donation be treated tax wise?
You want to answer that one, Jamie, or do you want me to?
Yep, I can. So when you are gifting the short-term appreciated asset, you do not get the tax benefit of being able to deduct the appreciation. So you would get to write off the basis, but not the appreciation that's in the stock. So not as good of a tax benefit.
And then real quick, can you explain the difference between short term and long term?
Yeah, so short term is you have held a stock for a year or less. Long term would be a year plus 1 day or longer.
Yeah. And short-term stock sales are recognized on your tax return as ordinary income. So where you fall in those marginal brackets. And then long-term it would be as a capital gain. And so that's a great question, Jeff. Any others?
No more in the chat.
All right, we'll move on. As I mentioned in the opening, we are gonna skip June, and then our next upcoming workshop is going to be July 24th. We're going to cover legacy planning, and then as you can see on the screen, we're going to do August, September, October, November, skip December, and then start probably a whole new series in 2026. So provide feedback. Jamie and I and the advisor team here FEG. Love to be able to do these workshops because it allows me to be a steward. So I'm able to give back my time and my knowledge to hopefully help give you all different strategies to think about and different perspectives of doing things just in a norm, in things that may or may not have been taught to you. So July 24th, we're going to talk about legacy planning. Um, I will preface that I am not an expert in legacy planning, so we will likely have a guest by the name of Darren Hardesty join us for legacy planning. Darren and I will interact and go through different strategies. I know a lot about the topic, but better resource than I am when it comes to legacy planning. Darren doesn't know that yet, but we've got a couple months to to at least let them prepare. So July 24th, Darren and I will come back and talk about legacy planning and looking at different strategies for future generations. We'll likely talk about the difference between trusts and wills, what type of documents you need to have prepared. All good conversations for making sure that you're making wise decisions for that next generation. If you heard something that sparked an interest, if you want to know more, if you want to just check your giving strategy and see if it's tax efficient, please schedule a meeting. You can see on the screen, you can have a complimentary meeting with an advisor on our team. That is where we will review your situation in an hour and a half, give you things to think about today, things to think about in the future, and if we decide to partner together, a written plan on what FEG will do for you. You can send questions to talk to FEG at yourlifeafterwork.com, and you can scan that QR code on the screen, and it will take you to a link where you can fill out more information. One of our team members will get back with you, and we're very happy to have a meeting with you. So thank you all for joining us. As I said, I would get wrapped up in under an hour today. We're 45 minutes in. Probably expect the legacy planning to take an hour because it is a very in-depth conversation. And so we'll spend a full hour in July. Thank you so much. You all have a blessed day. And again, thank you.